There's a misconception. People think like, hey, if someone's doing my tax returns, right now for tax, it's upcoming tax deadline, if they're doing my tax returns for last year, I'm assuming that they're helping me plan for next year as well. That's a huge mistake, right? To make that assumption. It's very well, someone like you who is proactive and your CPA knows you're on top of it. And so you're talking to them during the year and creating that story, almost recording the story as you go through the year, so that by tax time, you're just summarizing what already happened. Versus I think a lot of investors, even though they might hear and feel like they know the strategy, oh, I can take depreciation. Oh, there's 1031 exchange. But if you're not actually implementing it correctly before you sell the properties, then your CPA, however good they are, however they specialize in real estate, they're not going to be able to help you fix it.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. I'm so excited because I have Amanda Hahn with me, and I have been tracking Amanda, even though she doesn't know it. I have been tracking her and stalking her for years. She's unaware of this, but I first saw her present at the Joe LaHora Orange County Phoebe meeting many, many years ago. And then I've seen her again many times through the Norris group and situations where we both have been presenting, or where it's just I've been watching her because I've been, logged into a conference of some kind. And so she doesn't know this, but I've been recommending her for many a year in Keystone Investments, which is her company. And but now we finally get to have an interview. So Amanda is, I may be new to you, Amanda, but you are not new to me in any way, shape, or form. So let me read her bio so we can get her to share with us some of the questions that I have. So there's Keystone CPA Inc. There's their website. You can see it here. And that is Matt standing with her right there. Having helped thousands of investors, literally thousands of investors, across the U.S. to save on taxes, Matt McFarland and Amanda Hahn are founders at Keystone CPA Inc. As both tax strategies and real estate investors, Amanda and Matt combine their passion of real estate investing with their expert knowledge in tax strategies. Their goal is to help investors with strategies designed to supercharge their wealth building using entity structuring, self-directed investing, and income offset opportunities to keep more of what they make, which would ultimately be the purpose of a good CPA. From my point of view, is to help keep more of what you make. Amanda and Matt's highly rated book, Tax Strategies for the Savvy Real Estate Investor, is among Amazon's top sell list. There are also frequent contributors, speakers, and educators to some of the nation's top investment and self-directed IRA companies, as well as I said, she's part of the Norris Group, as well as she's part of the Phoebe Network. Their cutting-edge strategies have been featured on prominent publications, including Money Magazine, Realtor.com, AllBusiness.com. Matt and Amanda are speakers at Talks at Google that features influential thinkers and creators. They also appear on CNBC's Smart Money Talk Radio, as well as Bigger Pockets. Bigger names than our little Phoebe meetings, but we're super excited to have you come to our meetings anyways.
Thank you so much for having me. I love the Phoebe groups. It's always so great to speak at the Phoebe events, especially in person, right? When we all go back in person someday.
Yes, in person is definitely more fun. And last night, I actually had my Phoebe meeting, my Phoebe Pasadena meeting last night. And one of the things I said was, what do you guys miss the most about having been in COVID lockdown that you felt took you off purpose? Right? What is the thing that disappeared that you felt like took you off purpose? And there was a large portion of the responses were being able to see people in person. Mm-hmm. Like, it's just the capacity of being able to say hi and who are you as another human being, and let's hang out and talk. And, networking is such a large part of real estate investing. I know how I know you guys. I know you, right? I know you and Matt specifically through seeing you guys present at meetings in person and being able to ask people, so what do you think of those people on the stage? Are they cool? Are they good people or not? And, have you guys heard any complaints about them? And being able to develop a sense for somebody through that connection, through that community, and through that networking. And I use my network all the time to help me be successful in my real estate investing.
Yeah.
So here's my first question. Why CPA? Explain this to me. Because I'm such a real estate investor and I'm such not a CPA. So explain to me why taxes.
That's such an interesting question. I don't think I've been asked that before.
Okay.
A little bit about my background. I'm also a real estate investor myself, as well as my partner and my husband, Matt. But we didn't come, we kind of grew up in the traditional household. I think for, a lot of our listeners, if you've read the book, Rich Dad, Poor Dad, right? Something interesting about me, I think I grew up with a rich dad and a poor dad, and it was the same person. So I come from a family of real estate investors, actually.
Okay.
My grandparents were investors. My parents invested in real estate, but they never taught me to do real estate. They taught me to go the traditional route, go to school, get good grades, good college, and get a stable job. And what's a stable job? Well, CPA is one of them, right? People always have to get their taxes done. It's job security. It's safe because you're always in an office. So really that's the reason. I mean, not too sexy of a story. It's just kind of something my parents pushed me into. I was good at math, and so just something kind of I ended up doing. But what was somewhat interesting was when I started real estate, I used to work in one of the big four accounting firms, and I happened to be in the real estate group by accident. And that's kind of where I started to see the power of real estate investing when it comes to tax savings, and how there are so many strategies and benefits that are available to real estate investors. And that's sort of how my two worlds started merging, where I was a CPA, but also started to get interested and get involved on the real estate side as well.
Okay. And then, but I mean, I guess my favorite or least favorite, depending on how you call it, my favorite CPA story is when I was younger and I started investing before I understood investing, right? So I got this house when I was 17. It was my parents' house and my mom couldn't take care of it anymore. So I got this house and I rented it out to my godparents, who I called my aunt and uncle, and they bought it from me on an installment sale. And none of this made any sense to me. I knew nothing about any of it, right? All I know is that I was trying to help my mom out by taking over the family house, right? And then eventually it was like, hey, wait a minute, this kind of works. So I bought a condo that my brother didn't want, that he had bought, like this weird stuff. And so eventually I just started collecting real estate. But then at some point I did a 1031 exchange. And the person I used was my mother's tax person. So I did a 1031 exchange, and my taxes went from like 3,000, 5,000 a year to 32,000 the first year. And I was like, what? Wait, hold on. Explain to me. Why am I paying $30,000 in taxes? And she's like, well, you have this larger building now. I went from a single family to a multi-unit. You have this larger building now. So yeah, your taxes went up. And I'm like, this can't be right. This can't be right. So I took I started shopping CPAs, and I took my tax returns to these 3 different CPAs. And the CPA finally said, yeah, she miscalculated your depreciation basis on your exchange. And she's not a real estate expert. She is a CPA, is not an expert in real estate tax law or tax code. But because I am, I got a check back for almost like $25,000 or $28,000. Woohoo!
Huge swing.
Yes. That to me is the profound value of a CPA that is knowledgeable in real estate tax strategies. And that's where you guys have sort of specialized. That's what you have really aligned yourself with, is being that particular expert. So like, what are some of like the income shifting strategies for savvy investors? Like, that was one of the things that my CPA now knew that my previous CPA didn't know, was things like, how do you shift your income so that you get the tax results you want as a savvy investor?
Yeah. Well, I think a lot of one of the most common mistakes I see people make is investors not putting themselves in the shoes of a business owner, right? So there's always a lot of confusion around, hey, I invest in real estate. I have a couple rentals, or maybe just one rental in my own name. I don't have any LLCs or S Corp. Therefore, I can't, shift income to my kids, or therefore I can't write off a home office or my car expenses. And that's probably one of the most common mistakes that I see people make. IRS actually does not care whether you have a legal entity or not, right? If you are a landlord or a flipper or a wholesaler, you are a business owner in the eyes of the IRS, right? With or without a legal entity, you can take advantage of most of these tax deductions that you hear people talk about day in and day out. But I love that you brought up the concept of income shifting, especially, this is one where, for investors who have kids, we probably all agree that kids are, one of our biggest expenses during the year. And
I've noticed.
as they, and we were joking earlier, right?
Yeah.
I mean, as your kids grow older, they get more expensive. You can no longer buy those 99-cent toys and keep them entertained for hours. Then you're talking, video games, hair care product. I mean, all kinds of stuff, right?
LOL dolls. Like
LOL dolls, yeah.
I was totally guilty the other day. I literally bought these 2 little LOL doll packages and I needed some moments of peace. And I went, why don't you go check this bag that we have left over from our shopping we didn't unpack? I'm like, I just need to be entertained for 20 minutes. And it's like, Mom, where'd these come from? I said, I thought you might. It's just totally off and gone on them. And I got my 20 minutes of peace. I have to confess, I am guilty as charged, right?
Yeah.
So,
I do that all the time. I have my little emergency goodie bags that I pull out if I'm busy.
Right, exactly. So yes, but then again, I do have a kid and she does pay her own taxes.
Yeah. So when we talk about income shifting, it's really the concept. I mean, it's the concept is, how do we, instead of just giving money to our kids or buying stuff for our kids, how do we put them to work for our business, right? Our real estate business as an investor? How can they work for us so that the money we give them could be a tax deduction, right? So instead of maybe you buying her the LOL dolls, if she's helping you with your real estate business, right, with Zoom or with marketing, turnover costs, if she's helping you with those things and you're paying her to do that, then you get a tax deduction. Then she can take her money and go and buy her own LOL dolls or save it up for college or whatever it is that she happens to do. And it's something that's fairly easy, for investors to take advantage of, because, for those of us who have kids, we all spend money on kids. And so to the extent they can help us, it's one way to try to take some tax write-offs. I mean, if you're someone that's, between federal and California, if you're in a 50% tax bracket, if you paid your kids $5,000, that's a $2,500 cash saving that you would get, right? So the older the kids are, the more you can potentially pay them legitimately, therefore the higher tax savings. And this is another, just one example of a tax strategy that are available to most investors, regardless of whether you have a legal entity or not.
I like that a lot because, of course, I have a kid. So you're making me think, I'm like, geez, it's a shame my rental properties are out of state. Otherwise, I could get her to help me clean. She's 11 and a half, almost 12. So she's just now at that point where I could kind of go, okay, we're going to go clean. Let's go,
Yeah. I mean, I'll give you an example. My son who is turning 10, and, now with COVID, right, we're doing so many things on Zoom. And so we do a lot of, podcasts and recordings, or even just talking to clients. And I kid you not, he's the one that teaches Matt and I a lot of these things about Zoom itself. Like, I didn't know you can just press the space bar to unmute yourself, or little shortcuts on how you do things. So these are the things that, if you have a little bit older kids, they can help you with, right, with kind of troubleshooting technology and things like that for your real estate. So yeah, even if you have out-of-state rentals, it doesn't mean that your daughter has to physically work on the rental properties. There are a lot of other administrative, business-related things that the kids can help you out with as well.
When I was a kid, my mom owned her own small business, not real estate. She wasn't an investor at all in that way, but she owned her own small business, and I used to answer her phone for her. So yeah, so getting your kids involved in being able to be paid as part of your investing business, or whether it's just a traditional business, like my mom, who was self-employed, like she paid me as well when I was a kid.
I love that you said you used to work for your parents and they paid you when you were a kid, because, I was saying earlier, my grandparents are real estate investors. And so back in the days when I was really young, my cousins and I would always go and help with turnover stuff, not that we were doing anything major, but helping paint and things like that. And we were never paid, so that's my gripe. Now I'm telling my grandparents, hey, if you would have paid me back in the days, you could have saved some taxes. You missed out.
Well, also financial education. Like, the reason why I want my daughter to be able to do this, she's actually seeking, she's like, I'm almost 12, Mom, I can get a job. Like, she actually wants a job. And I'm like, I don't know, what job do you give 12-year-olds these days, right? It used to be they'd go get a newspaper out or they babysat, right? So now I'm like, well, yard work, babysitting, dog walking. So, we're having these conversations, right?
Yeah.
And so, but again, it's like financial education. If she gets money, then she wants to use that money to buy stuff. Then it's like, oh, well, you have $40. or a bank account, right? I had
Yeah.
my first bank account when I was 12, right? So it's like, here's how a bank account works. I remember my mom showing me the check register and how you use the check register. You know, I mean, financial education, I think, is hugely important and isn't something that a lot of people grow up with. So not only is it useful for taxes, but it's also useful for financial education and the basis of a financial education.
Yeah, and I think it's really invaluable lessons that you're teaching them, and also if they're working for you, it's just a lot of quality time where you can teach them all these other things. On the tax side, just one thing I want to bring up real quick, because when we're talking about income shifting, it is key to keep in mind that we are saying, the concept is when kids are helping you out in your real estate activities, right? And so what it's not is chores. So if you're paying your daughter to do chores around the house, load the dishwasher, fold your clothes, those we can't take a tax deduction for. So, from a planning perspective, try to make sure it's for business, that they're helping out in the business.
Unless so that you're going to the laundromat to do all the sheets for your short-term rentals.
Oh, I like that. Yes.
How's
Yes.
that? Now that it truly is not family laundry. It is the sheets for your short-term rentals, and therefore needs to be done every time the rental, rotates,
Yeah,
right?
definitely.
Right? That's a
Definitely. Yeah.
legitimate expense. So I like that. So shifting. So is there more you want to talk about on shifting, or can I ask the next question?
Well, I guess, for some of our listeners who maybe don't have kids, just a quick note, income shifting is not only limited to your kids. We use that as an example most often, just, because that's what's top of mind. But we have a lot of clients who are taking care of parents who may be retired and might be in lower tax rates than them. So that could be an example where if you're giving your parents money financially, maybe have them help out in your real estate business. Similar strategy where you can shift income to them, where they might pay lower taxes because of their lower income, and then you get a higher, a deduction at a higher tax rate. So it could be, kids, parents, any other family members, or even friends that, anyone you're helping out financially, to consider having them work for that money instead of just, giving them the money, and result in a tax write-off.
So I know one of the shifting strategies that I've heard of, which isn't necessarily related to real estate or not, is that you can also maybe have either a parent or a child, you can make a loan to the family member as a way of transferring wealth to them, right? And have a very, very low interest rate on that loan. And then you forgive the loan in pieces, right?
Yeah.
So like their kid wants to buy a house, so they're old enough to buy a house, but they're too old to be a dependent. Then you can make a loan to them and then forgive it over years. So that's not actually part of your deduction. See, now you have to tell me, there's a difference between the annual gift and the lifetime exception. So you have to tell me. So take it from there.
Yeah, it's so funny you brought that up, because we, a friend of mine, a client too, is doing that same exact thing where her son graduated college, just got married, and is going to buy a rental property. And so we're talking about, how do you help him, without incurring taxes and things like that. So that's the exact scenario you're describing, was, okay, well, let's make sure you draft up a loan to your son, and then every year you forgive part of that loan. The amount of money that you forgive during the year, usually we try to have that be part of the annual gift exclusion. So usually currently it's about 15,000 per person. So this means mom can forgive 15,000 to son, 15,000 to daughter-in-law. So, up to 30,000 of the loan every year could be forgiven. And then over time, it's a way to essentially, transfer that asset or the cash to your kids without having to worry about estate and gift tax purposes. So yeah, that 15,000 is under current law, is you can gift up to 15,000 to any individual over the year. So, if you have 20 kids, you can do, 15,000 times 20 if you wanted to, right? Kids, grandkids, right, and all that good stuff. But then we also have a lifetime where, the lifetime exclusion that's counted, if you're gifting beyond that 15 per person per year, that's what starts to eat into your lifetime exclusion.
And you can do that, but you don't have to wait until you pass away to do that.
Correct. Yeah, you can do it anytime. Now there are potential, that we're hearing rumblings of potential changes coming up maybe in 2022 with the whole, estate and gift tax. So it's certainly for, kind of the more higher net worth individuals and investors, it's certainly a topic to keep our eyes on. Currently we have, over $1 million of estate and gift tax exemption right now. There are talks that might change to just over $3 million. So a pretty significant decrease if this were to pass.
Yeah, I was going to say the current level is Is how much?
Roughly $11 million a
11
person.
million. I thought you said 1 million. I'm like, no.
No.
Yeah,
11
11 million. And it'd be loaded down to 3, not 5, because it used
Yeah.
to be 5.12 or something like that, right? Was the old level. And then it was raised to 11, and now they're looking at lowering it to 3.
Yeah, about 3.5.
3.5. Well, that's a number I actually track. As you can tell, I actually track that number. Because again, it is about shifting wealth, right? So, and being able to do that. And, I don't know, do you ever talk about life insurance as a way of being able to shift wealth as well?
Well, yes and no. So of course we do have clients who have, life insurance policies, right? Especially for those who have younger kids that you want to make sure, hey, if something happens to you and your spouse, that the kids are well taken care of. But I think oftentimes the struggle with a lot of our clients is thinking, if I have excess cash, is it better for me to put it into insurance, or is it better for me to use as a down payment for real estate, right? Which is appreciating and cash flowing. And I don't think there's a right or wrong decision. It's just, and maybe I have a skewed view of it because most of our clients are real estate investors. The vast majority of our clients, if they're faced with kind of, those restrictions of one or the other, we typically see people put that into the real estate side of things.
Sure, that makes sense. That makes sense. I happen to have both a policy on me and a policy on my daughter, as well as my real estate investing. And I call it my idiot proofing, because if I completely mess up my investing, at least when I pass away, my daughter will get something, even if I completely mess it up. Right. And so, and I have the same idiot policy on her in case she does nothing with her life. Although I hope, obviously I think she will, right? She's my daughter. I think she'll do something with her life, but just in case she does nothing with her life, at least my grandchildren will get something based on this life insurance policy that's on her. So some use insurance as a way of managing investment strategies, and that's really great. But to me, I just simple it down to it's my idiot proof policy. So
yeah. Same for me. I have a very similar structure that you talk about. It's just, you never know, right? It's planning for the unknown, essentially.
Planning for the unknown. So let's shift topics a little bit, and so let's talk a little bit about like California penalties to avoid for real estate investors. I mean, there's the whole LLC concept versus the S corp concept, and those are used for two different things. And then there are also penalties that would be associated that a lot of real estate investors won't be familiar with.
Yeah. For those of us living in California, obviously we enjoy the, beautiful weather and everything that good comes with it. But the downside for, many people is the high taxes, right? Which might still be increasing as far as we can see. Right. And, one of the questions we get all the time from investors is, should I have an LLC for my real estate, or do I do it in a personal name? So earlier we talked about, hey, for tax purposes, you can write off most of your expenses that are business related with or without a legal entity. That's not to say then that you don't need a legal entity, right? Because there are certainly still benefits of having a legal entity for landlords from an asset protection perspective. And so, where you form the entity, how many properties should you put in each entity? That typically is a good question that we recommend the investors talk with their attorney on. And the reason for that is because, if you were to get sued, you wouldn't call me as your CPA, you're going to call your attorney and say, hey, help me resolve this issue. Right. One of the issues we see, though, is for investors who are maybe not working with attorneys in California, they don't really understand the nuances of California law and all the taxes, if you will. And so what we often see is you have, clients working with out-of-state attorneys, maybe in Nevada or Utah or somewhere, and they'll say, hey, hey, Amanda, I formed, 5 entities. I have my baby LLCs, own my parent LLC, and I have a management LLC, and I'm feeling very good and safe, and which is great. But one of the things that maybe was not discussed is all of the fees that you have to pay in California for all of those entities, right? So California's position is that any entity ultimately owned by a California resident is subject to a minimum, right? A minimum of $800 per entity. So we got 5 LLCs, that's 5 $800 fees every single year, plus maybe filing tax returns. And so one of the issues is that was, okay, sometimes attorney will say, hey, let's just hide, right? Let's just hide from California. We have an out-of-state bank account. No one will see it. No one will know it. And that's all great. You can certainly do that. That's a strategy. That's an option. But I always want to be really clear for our listeners out there. It is exactly like it sounds. We are hiding from California. It's not saying you're set up so you don't have to pay the fee. It's just that you're literally, hiding because you don't have any addresses here and things like that, right? And so before, under old law, if California were to catch some of these out-of-state entities that didn't pay, it was a small penalty. Basically, you still pay the $800, and then there's like a $200 penalty on top. So for a lot of investors, they're like, hey, that's okay. I'm fine with that. It's a small risk. They changed the rule several years ago. So if you are caught with not paying the fees in California, the franchise tax board basically gives you 60 days grace period for you to make all the back payments and file the tax returns. After that point in time, the penalty goes up to $2,000 per entity per year. So it's something that's very huge for investors in California who are considering how many entities do I really need.
I have a lot of clients who ask me about that same sort of structure. Like, should I do multiple LLCs and then have a parent LLC, and only the parent LLC, which is generally a Delaware or a Nevada LLC, would register in California, right?
Yeah.
And that's what you're talking about, right? Is that you only register the parent LLC, that one, and that way you're only paying $800 once, and you're only declaring to California what the net income of the parent LLC. And that's all California gets to see.
Exactly. Right? And so, yes, so that's typically from a legal perspective, some attorneys will recommend that and say, hey, only the parent is doing business here, therefore only that one is subject. Unfortunately, California's position is they look through the different tiers and say, okay, I understand the parents here, but the babies, who owns the baby LLC? Oh, the parent. Okay, well, who's making the decision? If Christina is ultimately the decision maker on all of these things, then California's position is that all those babies are also doing business in California. Even if your properties are not here, they could still make that argument. Now, here's the good news, right? The good news is that we don't see a lot of audits on this. If it's done correctly, okay, meaning you don't have a California bank account, your attorney is your registered agent. Basically, there is nothing that the California will be able to see showing those babies connected to you. The audits of those are very far and few in between. Okay, so that's the good thing. But again, it's, I think it's no secret that California is hurting for cash. And
yes, California's hurting for cash and has been for several years now.
Decades.
We're like the 8th largest economic entity, 8th largest economy is California. And hurting for cash.
Again, California's position from the state's perspective is all those are subject to fees. So, it's not, it's possible that California at some point would step up the enforcement and try to come after all these fees. So every investor is going to have a very different risk tolerance level, right? But it's really important for people to understand that that is something that to potentially look out for, right? If you're considering, okay, should I have one entity or 5? How comfortable are you with, taking one position or the other, or do you want to pay fees on all of those entities?
And it doesn't assume it also based upon like the California code languaging is primary decision maker, not necessarily primary owner, right? So if I make my owner is 51% my lawyer, but my beneficiary is 98% me, and I'm still the primary decision maker, they don't care. You're the primary decision maker, right?
Yeah. So it's either or, right? Entities owned by California residents or doing business in California. And, the doing business is the part that's, it's subject to interpretation, right? Doing business, you can say, well, my property is in Virginia, so it's not doing business here. And then they would make the argument, well, then who is deciding when to hire the managers or fire the managers or, all these other decisions? Well, that's doing business because you're deciding from here, right? So those are the, and I think personally, I think that there's going to be court cases. If California really tries to enforce a lot of these, there's going to be court cases that go all the way up to try to, get rid of this. But, for us, myself, my investor clients, I don't think any of us are on that level yet where we would be the ones to spend a ton of money on legal fees to fight the state, right? So we're just hoping, some really other huge investor or business owner is going to fight that, and then we'll have a good outcome years from now.
Yeah, a lot of us mom and pops, even if we have 5 of these or 10 of these, right? It's not going to be worth it to us. We'd rather pay the penalty of $20,000 at $2,000 per entity, right? If we had 10 entities, then put that 20,000 towards multiple tiers of lawsuit, because that's going to become 20, then 50, then, so the penalty just makes more sense, right?
Yeah. And I do want to say, just to reiterate, right, doesn't mean that if you're caught that you will for sure pay the penalty. They do give you a grace period of 60 days or in the current law. So when you get a notice, you have 60 days to basically file the returns and get everything, corrected. And then you still pay the smaller penalty of $200. And so the key is to make sure that you will get the notice. What I mean by that is if your attorney is your registered agent, make sure that your attorney has your most recent address. What I see happen sometimes is someone will hire an attorney in Nevada. 5 years later, they decided, hey, I don't even know that guy. I never talked to him in 5 years. I'm not going to pay these registered agent fees. Well, guess what? When they get a notice to you from FTB, it's going in the shredder. And so by the time you hear from California, they are garnishing money from you. You're way beyond that 60-day, right? So if you're someone who is of the thought that you want to be more aggressive, you want to try to hide, just make sure that your registered agent always has your most recent address.
Yes. And I have an example of that as well. I created a Nevada LLC for a short period of time, and I had a registered agent, and I've stopped paying my registered agent. So if anybody wanted to sue my Nevada LLC, then I'm still like, I have no idea that registered. I can't even remember his name anymore. Right? Randomly, right? If something came at me from the histories, right? Because they can come after you for 7 years, right? So, in 7 years' time, you could completely forget the name of your registered agent. Just saying. Let me change the topic just a little bit, just one more time. So let's talk about, upcoming, right? What are new and pending tax changes that you really feel like real estate investors need to know? Because I'm very involved in my tax return. I was, that whole story about the CPA and finding the new CPA, right? So one of the ways I chose this new CPA was I was at a real estate, I was at a meeting of some kind, and this guy was a CPA, and I'm like, can I take you to tea? Because I want to ask you some questions, because I have this $32,000 tax bill that I paid that I want to figure out, right? And he was, he's older than me, and he's now truly an old gentleman, but he's still my CPA. And he said, Christina, here's what you want. You want to make sure that you're telling the IRS the tax story you want them to see. The primary purpose of the entities is so that you can cultivate the tax story that is on your personal returns, that's on your the parent or the parent company and all the sub companies. You want to be able to shuffle through all the K1s, the story that you want the IRS to see so that you can take advantage of this. So I'm a great believer in cultivating the story that you tell the IRS every year through your entities and your tax returns, all the way down to your personal return, all the way down to my daughter's return. Right? So the whole package is done at the same house, a CPA house, so that I get value out of that. So therefore, I care a lot about upcoming changes in tax code, and I rely on my CPA to tell me that. So tell me, what are some upcoming changes that people need to know about if they're like me and that they really care about being able to cultivate the story?
Yeah. First off, I love that story you shared. I've not really heard it expressed in that way, so I might borrow it for future.
Borrow it, absolutely. Because I was not a savvy investor at the time. I was new to taxes. I was new to this concept of why do I need multiple? And I was that person, right? I'm like, why do I need to put anything I own I own my first properties in my own name. Why do I need to put them in another name? Oh, liability, tax. I don't understand all this. And so he was very kind, right? And explained it to me in a very approachable fashion. So please steal it, because it's worked for me for decades.
Yeah, it's true. And I think a lot of people, there's a misconception. People think like, hey, if someone's doing my tax returns, right now for tax, it's upcoming tax deadline. If they're doing my tax returns for last year, I'm assuming that they're helping me plan for next year as well. That's a huge mistake, right? To make that assumption. It's very well, someone like you who is proactive and your CPA knows you're on top of it. And so you're talking to them during the year and creating that story, almost recording the story as you go through the year, so that by tax time, you're just summarizing what already happened. Versus I think a lot of investors, even though they might hear and feel like they know the strategy, oh, I can take depreciation, oh, there's 1031 exchange. But if you're not actually implementing it correctly before you sell the properties, then your CPA, however good they are, however they specialize in real estate, they're not going to be able to help you fix it, right? So I think that's huge, and tax planning is so important, especially in today's climate, when we're talking about potential tax changes, right? Because now in normal years, all we have to do as investors is to kind of make sure we update our CPA on what the transactions are, right? Hey, I might sell this one, or hey, I'm going to refinance, pull cash out and move it over here. So those are where the planning comes in play. But now, in addition to that, we're also monitoring what are the changes in taxes. Whereas before, if I told you, hey, let's make sure we maximize depreciation, well, I may not recommend it for 2021 because maybe tax increases are coming up next year, in which case your tax might be, twice as high as what it is currently, right? So those are the things we're monitoring. So I guess, some good news and bad news in potential tax changes. The good news is nothing is definitive yet, okay? That there's nothing, none of the proposals that we've been hearing about, actual increases in tax rates for individuals or increases in capital gains tax rates. None of those are set in stone yet, right? In fact, none of those are really being voted on as we speak. So those are still just very preliminary. So that's the good thing, which means we still have time to plan. The bad thing, though, is the current administration has come out, right, and said that there's going to be a focus on tax increases. I don't think anyone is in denial. No one's talking about tax cuts. We are all preparing for tax increases, clearly because of the pandemic, and just some things have to occur to kind of take control of the deficit, if you will. So our expectation is tax increases, but one of the things that was kind of interesting, the administration has said that part of the effort is to take away unequal and unproductive tax breaks for real estate investors. Okay.
Unequal and unproductive.
Yes, and so those are strong words, right? Because what is the definition of unequal? That's what is the definition of unproductive? Is depreciation unproductive? I don't know. I guess you can make the argument. Unequal, is it, real estate professional strategy or the ability to write off rental losses? Is that unequal to someone who maybe doesn't own real estate? You could certainly look at it that way. So if we look at just that statement by itself, it kind of sounds scary, could be really, anything. There has been talks.
I have suspended losses I've been cultivating for years. Don't take my suspended losses from me, please.
I know. Let's see. Are they unequal and unproductive?
Oh, they're not unproductive to me, but I could see how they'd be perceived as unequal, because as a real estate professional, I get to roll my suspended losses forward. But if I was not a real estate professional, I couldn't roll these suspended losses year after year the way I do. I just use them. I just use them as I need. Right? It's an automatic shelter.
Yeah. If you're a real estate professional, you could just use it all. If you're not, yes, you just, carry it forward.
But I only get to use a piece of it, right? There's a limit. If I wasn't a real estate professional, there's a limit as to how much I'm allowed.
Right. Yeah. How much your income is, and, all sorts of fun tax things. So, some things that we've heard that, not really in the proposal per se, but, when we talk about unequal and productive, maybe potential changes to 1031 exchange, right? That's one that's kind of near and dear to investors all over the US, especially in California, where we have such high appreciation. So that's one we're keeping an eye on. So, I want to really, and it's, sometimes people say, well, gosh, you haven't told me anything. You told me tax might go up, but we don't even know what it is. Which is just the truth, right? Unfortunately, I don't know what it is. And I don't think any CPA or tax attorney can tell you what exactly is going to happen. But I think what's important here, though, is what does that mean, right? So what we know is there could be tax increases. Some of those could be targeted at real estate investors like us. So what's the action item now? Well, the action item now, I think, is to take a look at your current plan. What is my current tax strategy plan? Is it depreciation? Oh, is it I'm claiming real estate professional? Do I have passive losses, right? So assessing where you are right now, so you're prepared when things happen. What are some maneuvers I need to do? but also taking a look at your portfolio too. Right now we can still do 1031 exchange. If you wanted to sell something in California and replace it with a dozen out-of-state rental properties, you can do that. If the laws were to change, though, it could change where you won't be able to do that, after the date of enactment. And so those are some things we can do now, is look at our portfolio and say, okay, if this were to change, which ones would I sell? Which ones would I keep? And where would I want to replace my properties, so that if the tax law changes, you're ready to kind of implement and jump on those investment decisions.
All right, I'm going to completely change topics. So I happen to know that you do have your own investments, and yet you help people with taxes. And so helping people with their taxes, with their real estate investing, hasn't scared you away from being an investor, which is good, right? If anything, hopefully it's helped you maybe even feel more prepared to be an investor, because this is a language that you're involved in every day in your work life, as well as in your personal investing life. But there are times when things go wrong, right? So tell me about, in your own portfolio, something that has gone wrong in your portfolio, and how did you deal with it?
Mm-hmm.
Sometimes it can be really upsetting.
Yeah. Well, sometimes I think it's always very upsetting. Always very upsetting when deals go bad. But yes, I think I think Matt and I were so fortunate in that, for us, we really get to see the inside scoop on all types of real estate. We have investors all over the US that do all kinds of real estate, not just rentals, but we have flippers, we have wholesalers, we have people that are doing notes, people who are investing in notes. So I get a unique insight into like what's working, what's not. Oh, and we have a lot of short-term rental operator clients too, which, as you probably know, has been huge, right? Phenomenal. So I get a kind of sneak peek into really what that looks like financially, and what performs well and what doesn't perform well. I think one of the biggest investment mistakes that I made, and this is just myself, so I'll take Matt out of it.
Okay.
Was early on, when we were fairly green investors. I think by then I had maybe just one single family myself, and I wanted to get into large multifamily. Right? It was, for me, it was like, I'm a smart person. I'm just gonna go. I'm skipping the first grade. Oh, sorry. I'm skipping first grade. I'm going right to high school.
That's right.
Oh, sorry. Did I turn off my mic?
No, you're good. I can hear you.
Okay, sorry. So I was at an event and I met a person who was doing apartment syndications. And I thought, that's exactly what I'm looking for. Deal one is single family, deal two is multifamily. And I just realized that was the way to do it. I really, really liked this investor that I met. He presented his deal to me, and I just thought this was really great. It was his first deal. But I felt like this was how I was going to get involved in multifamily. So it was a syndication deal. I was a passive investor in it. And to make matters worse, I used my retirement money. So, self-directed investing is a strategy we talk about all the time with our clients. And I was my first test case of, hey, I'm going to do it myself. How do I do it? I left my corporate job and now I've controlled my retirement, used it to invest in this multifamily deal in Texas. I think about 3-4 months into the deal was gone. Effectively, it was a forced appreciation play that they weren't able to get the bridge financing done. So the money was, completely gone. And so the lesson I learned from that, lots of lessons, but one of the lessons I learned is to really do due diligence, especially when you're partnering with other people. You can't just fall in love with the person or their business plan. You really need to do due diligence, not just on the real estate, but the individual, because they are someone who, it's almost like a marriage, right? You're joint decision makers, or in the syndication perspective, they are the decision makers. So whatever they decide is the result that we will get. And but since then, I think sometimes people say, oh my gosh, I never want to invest in other people's deals. Then I'm never doing that again. But I took an opposite approach. I felt like, I learned that, and I know there are a lot of great syndicators. And so even today, I have a couple syndication investments of my cash as well as my retirement account that have performed great. So, a learning process nonetheless, but it was painful, like you said.
So let me ask you this question right off of that one, right? So You have a perfectly lovely company, you and your husband, right? You're CPAs. You guys probably have a pension plans that you're developing. You're entrepreneurs. And yet you invest in real estate, which can be risky and can be a pain, right? Why use real estate to help you break through to your financial freedom? Why not just rely on your company to help you get that breakthrough to your financial freedom?
Well, I think it's, we're doing both, right? So our business is where we actively pursue our income and our growth. And it's something we're really passionate about. Matt and I, at some point we had decided many years ago, like we were on this pathway, like, hey, let's do real estate full time and get out of the business. And in that process, we realized we really love the tax planning side of things. That's kind of what we're also passionate about. But why real estate? I mean, real estate is I know you mentioned risk. But for me, I feel like it's one of the asset classes with maybe the least amount of risk compared to other alternatives, right? I'm not an expert in stocks and things like that. So I feel like there's less risk than some of the alternatives.
Mhm.
Of course, I love the appreciation in the cash flow and the tax benefits that you get from real estate investing, right? That's
Right,
what my main job is, to teach people about that,
right.
and how real estate can help you achieve financial freedom faster with the added benefit of tax savings.
Mhm.
But yeah, it's just something that we're really interested in. And I know you mentioned the headaches of being an investor. And, for me, I guess we don't really see it as headaches, but a little bit skewed because we don't self-manage any of our own properties. So I do have people who do that part. The
Mhm.
acquisition side, kind of the planning for the real estate and what we're doing with the property, those are fun. To me, it's just like another business, and the system, creating systems around that is really what we find actually fun, more so than a hassle.
So thank you for your answer, because I love that answer. And I love that answer because it's a little bit different than the answer I normally get. Because I think what's underneath your answer, if I may, you said earlier on, which is we don't really have a very chaotic real estate portfolio. Like we actually have structured it so that we have rental properties with a property manager. We have syndication deals that are, humming along. Like we didn't create a dynamic, full-time job real estate portfolio where a flip can blow up on us, because we're not doing those. And so therefore it makes perfect sense to you as a expert in real estate tax code to own real estate, which I agree with you, I think is less risky than like the stock market, where I'm not an expert. I can make informed decisions about real estate movements I cannot make in the stock world, and I can't make in the currency exchange world. Right. And I don't believe, forgive me if somebody's going to shoot me for this, I don't believe in gold either as being a primary commodity that is a shelter, because every time I see gold move, I rarely outperforms significantly what is done previously, because it's just as cyclical as real estate. Personal opinion. But the point being is that real estate actually is less volatile and a slower moving investment vehicle than some of the other vehicles we can invest in. And you can be highly knowledgeable and manage it yourself. Right. So you've actually chosen to create a real estate portfolio that doesn't have a lot of chaos in it, doesn't have a lot of variation in it, probably not necessarily very sexy for those young investors who want to have like multiple office buildings or multiple, $1 million single short-term rentals that's, rent out to the stars or whatever it is they want to do. But it serves you in being able to create a balanced retirement.
Yeah, and I think it's interesting because we have, especially for newer investors, right, that we meet and we work with. A lot of times they want to know like what type of real estate they should do. Hey, I went to a Phoebe meeting about wholesale and I'm interested. And a month later, oh, I learned about mobile home parks. I'm going to do that. And I think it's really important to to take a look at your personal life too, right? What your personality, how much time you have, and then just do something that kind of works well with your overall profile in life in general. Because it's tended to be fun. I have clients who are doing short-term rentals that they self-manage, and for some it might be, slit your wrist, like that just sounds terrible. But for this particular client, she loves it. She loves staging the property. She loves dealing with the tenants, and even tries to help them schedule things locally for bachelorette parties, and just get so much joy in doing that and making a ton of money. So I think it really is, person to person, but understanding kind of what you like to do on a day-to-day basis is key.
Yeah. All right. Thank you for your time. If people want to get a hold of you, how do people get a hold of you other than your website? So we got keystonecpa.com is your website, right? But I also know that you have a really cool book So why don't you walk us through a little bit? So this is your website and what?
Yeah. So actually on our website, we have a free ebook that anyone is welcome to download. You can just go to www.keystonecpa.com and you can get a copy. In addition, if that's not enough reading for you, we also have written 2 books on, you can find them on Amazon. It's called Tax Strategies for the Savvy Real Estate Investor. And the second book is Advanced Tax Strategies for the Savvy Real Estate, or just called Advanced Tax Strategies for Real Estate. So, if you're looking for a tax book about tax codes and calculations, that's not it for you. This book is not written for CPAs, it's written for investors. And so it's full of stories about how people were able to save taxes using real estate. And we also, of course, had to include some nightmare stories too about when people do.
You have to be fair, you got to, because that's where you actually learn your tax code the best. It's when you're in the middle of one of those, just from my point of view. Maybe I'm a little dense. Maybe I should be learning things sooner than when I'm in trouble, but hey.
Yeah, no, that's life, right? That's just life. So yeah, good reading. Check those out. And those are the main places to find me. And we also have, on our website, we always post frequently updates. So we have our podcasts and stuff where we speak for other venues. So yeah, check those out as well.
So these are podcasts that you've done for other people, like the one you're doing today.
Exactly. Yeah.
Perfect. All right. So people, and listen, I always like to try to give out a phone number for those who are old school and actually use a phone.
Yes, our phone number is 877-975-0975.
Okay, 877-975
0975.
0975. Beautiful. Thank you, Amanda. Thank you so much for your time. I really appreciate you taking this morning with me. I am Christina Suter with the Real Estate Breakthrough Show. We've been interviewing Amanda Hahn with Keystone CPA. And I am super excited. Hopefully you guys will tune in next week for our next guest speaker and or our next EDU segment.